You are watching vTalkInsight, Risk Sentiment Daily for February 23, 2026. Equities are edging higher even as oil, inflation, and private credit stresses keep nerves on edge. So the key question is whether the risk-on bias can withstand mounting tail risks. Let us begin with how overall risk sentiment is setting up across major assets. Overall risk sentiment today is cautiously risk-on. The S&P 500 has added close to 0.75%, while the VIX has slipped back below 20, signaling that headline equity volatility is contained even as the news flow remains noisy. That backdrop tells us investors are still willing to hold risk, but are doing so with a clear awareness of the downside scenarios. Across regions, risk assets are showing resilience. Asian equities are holding up despite Brent crude trading near 6-month highs, and European indices are rebounding from earlier losses, led by luxury and financial names in France and the United Kingdom. At the same time, survey and positioning evidence suggests institutional investors remain overweight risk assets and are prepared to add exposure, helped by robust liquidity and ongoing inflows into both public and private markets. Below the surface, however, the tone is far from complacent. Gold has surged to record territory with silver rallying sharply, option skew and volatility in precious metals are elevated, and the US dollar has regained its safe haven appeal, all pointing to active hedging alongside risk-taking. With oil-sensitive geopolitics, private credit liquidity strains, and sticky inflation all in play, the dominant mood is one of staying engaged in risk while keeping protection in place and treating shocks as live possibilities rather than tail fantasies. A key bullish driver today is that tariff rollback boosts disinflation and cyclicals. The U.S. Supreme Court has struck down the administration's broad emergency tariff authority, immediately halting the collection of a major set of import duties that had acted like a sales tax on consumers and retailers. Tariffs that previously ran as high as 40 to 200% on some categories are being unwound, removing an important inflationary overhang from goods exposed to those measures. Equity markets have been quick to identify winners. Consumer durables and apparel stocks, including high-profile names such as athletic and leisure-wear brands, have outperformed on expectations of margin relief and improved pricing flexibility. European luxury exporters, including large houses in France, are also rallying as better access to the U.S. market and a lower tariff drag lift the earnings outlook for high-end goods tied to U.S. demand. From a macro standpoint, the ruling supports the broader disinflation narrative. It removes one of the more visible sources of tariff-driven price pressure at a time when core inflation is stuck around 3%, even if companies may only partially pass lower import costs through to end customers. Counterbalancing this, there are fiscal and policy caveats, since tariff refunds and lost revenue could widen the deficit, increase Treasury issuance, and keep some upward pressure on yields, while the administration still has slower, more constrained legal avenues to reimpose targeted tariffs. Another important bullish force is that AI capex supports tech and growth. Hyperscalers are projected to spend around $600 billion on AI infrastructure this year, roughly $200 billion more than last year, and a renewed $30 billion funding commitment between a leading chip designer and a major AI platform underlines the urgency behind that build-out. This wave of spending is benefiting hardware, semiconductors, and materials, and is feeding into a broader acceleration in global capital expenditure, not just in the United States but also in Europe. That investment is showing up in earnings and market leadership. U.S. large-cap technology remains attractive globally, with superior earnings growth, strong operating cash flows, and resilient revenues, all tied in part to AI-driven demand. Data center and semiconductor stocks are expected to remain well-supported as long as political and financing conditions stay stable, and strong results from key chip and infrastructure names are seen as potential catalysts for renewed leadership. There are, however, non-trivial risks around this AI build-out. On the funding side, the failed $4 billion data center financing for a key AI infrastructure player and rising credit concerns in that niche show that not every project can rely on cheap or abundant debt, especially in a higher rate world. On the competitive side, Software and cybersecurity names have sold off sharply on fears of AI-native disruption, highlighting that while AI capex is a strong tailwind for enablers, it is simultaneously a headwind for parts of the legacy software universe. A third supportive factor is that strong liquidity and risk appetite persist. Institutional investors remain overweight risk assets and indicate a willingness to add further exposure as long as systemic risk indicators stay contained and liquidity events remain isolated. A significant volume of capital from consumers, sovereign wealth funds, and corporates continues to seek deployment, underpinning valuations across both listed markets and private assets. Within private credit, despite headline noise, fundamentals in many sponsor-backed and secular growth loans are described as solid, with default rates still low and yields having moderated from around 12% to a 9 to 10% range that remains attractive relative to other fixed income. Globally, flows into international equities have accelerated to their fastest pace in 5 years, driven by themes such as AI, defense spending, and de-dollarization, even though broad economic strength outside the U.S. is uneven. This combination of liquidity and selective thematic interest helps explain why equity pullbacks are being absorbed and why overall volatility has stayed relatively muted. Turning to the key headwinds, Middle East tensions and oil shock risks stand out as the dominant bearish driver. The United States has assembled its largest military buildup in the Gulf in decades and issued a tight deadline for Iran to come to terms on nuclear and missile issues, with open discussion of potential strikes within the next couple of weeks. Analysts warn that any military action could trigger rapid Iranian retaliation, including missile attacks on regional partners and, crucially, threats to tanker traffic and energy infrastructure. Energy markets have already responded with a visible risk premium. Brent crude is trading near 6-month highs with estimates of a $3 to $10 per barrel geopolitical premium, and scenarios involving closure of the Strait of Hormuz see prices spiking toward $100 or even $120 as up to one-third of global supply is threatened. Given estimates that a 10% move in crude typically adds around 15 basis points to headline consumer inflation, a sharp spike would risk reigniting inflation expectations at a time when labor supply is tightened and the economy is more sensitive to commodity shocks. There are mitigating elements, but they do not remove the risk. Saudi Arabia and the United Arab Emirates are expected to raise exports to stabilize prices if Iran disrupts transit routes, and history shows that oil spikes linked to temporary disruptions often reverse quickly, with equity sell-offs proving short-lived. Even so, the prospect of a supply shock is fueling demand for the US dollar and precious metals, keeping a lid on rate cut expectations and posing particular downside risk for cyclical equities that have benefited most from the running hot growth narrative. The second major concern is private credit liquidity stress and opacity. Several large private credit vehicles targeting retail investors are seeing redemption requests spike, with some funds reporting withdrawal demands rising by around 200% in the latest quarter. In response, firms such as Blue Owl have restricted withdrawals from specific funds and resorted to selling a $1.4 billion loan portfolio, in part to meet liquidity needs, with the stock trading lower as investors reassess the business model. These developments highlight structural vulnerabilities in an asset class that was marketed as stable and illiquid, but has been open to clients who expect periodic access to cash. Duration mismatches, complex links between private credit funds and insurance company balance sheets, and limited disclosure are all raising questions about where losses would ultimately sit in a severe stress scenario. Regulators and policymakers are starting to push for tighter oversight and more transparency, while equity markets have derated business development companies and large alternative asset managers on worries about contagion and future fundraising. It is important to distinguish liquidity stress from outright credit deterioration. So far, default rates in sponsor-backed and secular growth segments remain low, and Blue Owl's ability to sell loans near par suggests underlying credit quality is still reasonable and that there is deep capital willing to transact at current spreads. Even so, the optics of gated funds and forced asset sales are likely to encourage more conservative underwriting and may tighten financing conditions for middle-market borrowers that depend heavily on private credit channels. The third bearish driver is sticky inflation and higher for longer Fed risk. Recent data point to U.S. inflation increasingly anchored near 3%, with core personal consumption expenditures running at about that level and core services proving particularly stubborn. Market demand for inflation protection via Treasury inflation-protected securities remains strong, and there is growing concern that another commodity or wage shock could push expectations higher again. This inflation backdrop is feeding directly into policy expectations. Hopes for rapid U.S. rate cuts in 2024 have faded, with some participants now openly contemplating the possibility of renewed hikes, while the Federal Reserve signals little urgency to ease and appears comfortable tolerating above target inflation for an extended period. The entire Treasury curve has shifted modestly higher, and a prolonged pause risks keeping real rates elevated, which in turn weighs on long-duration growth assets and supports the dollar over time. To sum up, risk sentiment is cautiously risk-on, with tariff relief, powerful AI capex, and abundant liquidity keeping equities supported even as oil, inflation, and private credit stress complicate the backdrop. The bullish forces of disinflation from tariff rollbacks, structural demand for AI infrastructure, and persistent risk appetite are being tested by Middle East tensions, liquidity strains in private credit, and the prospect of a higher for longer Federal Reserve. Watching how crude prices, private credit flows, and inflation data evolve from here will be crucial for understanding whether the current balance between taking risk and hedging it can hold. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.